Hello, everyone. I'm your host, Cam Webster, and welcome to The Art of Boring, the podcast where we dive deeper into Moore's investment philosophy and thinking in order to help you, our listeners, become more informed investors. Ultimately, we hope to connect you with the people at Moore who find excitement in delivering on Be Boring, Make Money. On this episode, we investigate the world of not-for-profit clients with institutional portfolio manager Andrew Johnson. Together, Andrew and I introduce you to Community Foundations of Canada and cover a few key areas of concern for its membership. Thanks for listening.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
Welcome, everybody, to the Art of Boring podcast. Today, we're going to change it up a little bit. We've got two colleagues, so myself and Andrew Johnson. We're both institutional portfolio managers. So first of all, welcome, Andrew Johnson.
Thank you, Cam.
So we at Moore have a partnership with Community Foundations of Canada. We've had that partnership for 5 years now, Andrew?
Yeah, a little over 4 years, yeah.
And briefly give us an introduction of what that partnership is and why we do it.
Sure. Well, I think if we step back a little bit and realize the fact that we've been managing money for community foundations for quite a long time now, and if we even step back a little further and talk about foundations and not-for-profits in general, it's been about 30 years that we've been managing portfolios for them. But back in 2014, a really long-time community foundation client of ours introduced us to the leadership team at Community Foundations of Canada, which is the CFC. They're essentially a national organization for all of the 191 community foundations around Canada. And they essentially act as a network for this group, allow them to share information with each other. If you can put yourself in their shoes, they're dealing with a lot of similar issues, just in a very nuanced way in each case. And they also take a lot of these issues to the federal level. And they're now working globally as well. So leveraging all of the work that's being done outside of Canada as well as inside as a group and bringing that to the community foundations around the country.
That's a great setup and a good segue into, okay, so why are we sitting here having a podcast about not-for-profits? So we actually went to the CFC and asked them, are there questions from your membership that you want answered from an investment manager point of view? So let's just kind of go to the question list because that's why we're here. The first question involves how does a not-for-profit, how does a community foundation go about selecting an investment manager? So you and I have been through the process several times. So why don't you start? I'll pipe in where I see fit.
Well, I think that this is one of the more common questions that we get from not only just our group of community foundation clients as well as the broader CFC group. But in general, a lot of volunteer boards and investment committees will come to us and ask us these similar questions. So there's two buckets that I would generally try to assess how to select an investment manager. One is on a quantitative side of things, and the other is on more of a qualitative aspect. And I think this is my opinion, but I think it's relatively straightforward and simple to gain an understanding of the quantitative characteristics of an investment firm and how to assess that. I might be a little biased because we work with numbers on a daily basis, but in general and relatively speaking, I think it's relatively straightforward to get that judgment in place from a quantitative standpoint. Where we tend to see a lack of understanding or probing is on trying to get an assessment from the qualitative standard that you want in your investment manager. So this is very much a long-term relationship that you're trying to strike. It's a marriage. It's not something that you would spend just 5 minutes kind of superficially picking your partner out of a lineup. You would spend a lot of time thinking about it and thinking deeply about it. In general, I would bucket things into kind of three main areas. So I'm going to cover off sort of the who, the what, and the why of selecting an investment manager for a foundation. So starting with the who, I think it's really with the board or an executive of a not-for-profit or a community foundation in this case, it's their fiduciary duty to themselves, their donors, as well as the stakeholders that they have to select an investment manager that they trust to manage their assets in the best interests of their foundations. So we're trying to get a sense of the firm you're interviewing and the people that are being interviewed from that firm. So questions like how long have you been in the business is an obvious one. how many employees do you have and what's been the turnover of people. I think these are really good icebreakers to get a sense of their experience. In the case of personnel turnover, I think it's probably a really good sign if that's low, and it's probably a sign that the individuals that work at that firm are passionate about what they do, and likely the firm as a whole has a really good culture. Also, you want to ask, what's your experience with other not-for-profits? I think you want to find out how many clients, the dollar amount of those assets that they manage, as well as the years of experience that they have with not-for-profits and foundations, and find out if they volunteer with a not-for-profit. I think having a manager that is able to see things from your point of view and your side of the table, as it were, is a definite plus. So moving on from the who, I think we want to gain an understanding of what the manager's investment philosophy is and if it makes sense and lines up with what you're looking for in a manager. So the obvious question there is, what is your investment philosophy and process?
Right.
But the answer that you're looking for is really, I guess a manager should be able to explain their investment philosophy and process generally in layman's terms, and it should be easily understood. So the next question that you want to ask yourself is, does it make sense? If it comes across as complex and based on a lot of predictions and forecasting in order to be right, that's probably a red flag, and maybe you want to take a step back and reassess what you're looking at. Similarly, if it's presented as being some sort of new way of investing and that they've discovered and they're all about, I think that's also a red flag. I would actually say step even further back. I think that most successful long-term investing principles come from investment philosophies that have really stood the test of time. So we're generally talking about multi-decade here as opposed to multi-year. Further, you also want to get an understanding of what that manager's thoughts are on risk. So find out if risk is top of mind and how they think about it. Do they classify risk as more short-term measures, or is it volatility and standard deviation? Or do they view risk from a more absolute perspective? Generally, how we discuss it around the firm here is the permanent impairment of clients' capital. So in other words, an absolute dollar loss that is just can't be recovered. And I think that helps you understand how they view the importance of downside protection.
Let me recap. We're talking about quantitative, qualitative measures, understanding the investment manager's investment process and philosophy, but also digging in terms of long-term. The focus is long-term. That's what I'm hearing so far.
Mm-hmm. In the context of long-term, I think the next logical step is to try to figure out how an investment manager has performed through various different market scenarios. So you want to be able to look at examples of different market environments, periods of time, to see how their approach has performed.
Yeah. So we're in the quantitative bucket now. So what I'm hearing is it's a combination here.
Yeah, absolutely.
And is there any one that takes priority over the other? So when you're helping a foundation out, do you emphasize the qualitative more than the quantitative, or is it kind of down the middle?
That's a good question. And I think how I would describe it is the quantitative things will get you in the door. The qualitative things will get you the job.
As an investment manager.
Manager.
Okay.
So again, just recapping, I guess, that final piece of the what, which is finding out how an investment manager has performed over different market scenarios, especially bad ones. So they should be very open about sharing that information. If they're not, then I would be wary of that, obviously. And even though historical performance, I think, is not the greatest, if at all, indicator of future.
Disclaimer.
Exactly. It does allow you to give a fuller judgment, I guess, of the approach that a manager has and how that has unfolded during real world scenarios.
Joking aside, one of my recent meetings to a not-for-profit, we got to the performance page and it's rolling returns. And it just really hit me at how strange markets we've been in. Because every number on the page, both asset class and benchmark, was positive. And in my 25 odd years of investing, rarely do you see a performance page that isn't a mixture of numbers. And these were all positive. I just want to pause there and emphasize that the need now to look long-term in terms of evaluating what your needs are as a foundation and what type of investment manager you want to hire. Like you said, I think it's got to be multi-decade, because otherwise you're gonna annualize a 10-year period that looks like it's a bit of an aberration.
Yeah, exactly. And I would even go, in my career, which spans just prior to the global financial crisis.
No, don't date me.
I at least got to experience that. But there's many people that are sitting on a volunteer board or sitting in an investment committee, even working at investment management firms, that have not faced that type of scenario unfolding. So it is important not just to go back. Multi-decade probably captures at least most certain time periods that have a negative return environment. But I wouldn't classify it as such. I would just say try to go back to whenever the last big blow up in the markets was and see what happened with their portfolio. In this case, it would be 2008, 2009. 2011 was a little hiccup, and so far we've been running upwards from there. So it's hard to judge when the tide's coming in all the time like that.
Yeah, one interesting way to get rid of all those positive numbers would be to go to calendar year returns and go back 20 years, and you'll capture some of that. So,
yeah, you'll capture more of it. Yeah,
that's
absolutely.
The basis as a committee if you're sitting trying to select a manager to say what happened here. Okay, so we covered the what's, and you mentioned the how's.
Yeah. So, well, I was going to end with the why actually. So, I think
what, how, why. Good.
So. I think when it comes down to it, we just spoke about, quantitative getting you in the door, qualitative getting you the job. I think that a lot of the times what ends up happening is that you're faced with a decision among very similar offerings in front of you if you're a foundation. So you've narrowed it down. You've got 3 investment managers in front of you. I think ultimately you have to ask yourself, why would you choose one over the other? And I think some of the factors that are important to foundations would be things like, do you give back to your community? If so, how do you go about doing that? What is the impact of that? How are the individuals compensated? And do you invest alongside of your clients? So I think what we're getting at here is trying to find out what kind of alignment we have between a foundation in this case and the investment manager. Obviously, you want to know what they charge for fees and what you can expect from client service. So I think that those questions can really help you differentiate when you're faced with a difficult decision like that. These are all things that I probably think are most important to foundations and community foundations in general. As I said, I think it's relatively easy to get to some sort of quantitative judgment, but I think it takes a lot of deep thinking time and really good questions to get an understanding of the qualitative side of things.
I think we've given people a really good framework to potentially select a investment manager from. You closed out saying really good question. So here's another really good question I think that's been submitted. How does an investment manager adjust to changing demographics? So I think we can answer this, Andrew, in the context of how foundations maybe change with demographics and go from there.
Yeah, absolutely. And I obviously want to hear your input on this too. And I know that we've had a lot of conversations about it. But ultimately for me, I think it all comes back to technology. When I think about an investment manager, 2 really important characteristics come to the top for me. One is just how good they are at investing. And again, do they have a good philosophy and process? And does that work over time? One aspect of that is how they use technology, data, analytics, just sheer computing power to complement that process. And I think we've seen it here at Moore and in the industry where we're hiring data scientists and technology experts to help us enhance that. So that's on the investment side. I think the other side of it, the client experience and the service delivery. So as clients, and you and I are both clients of Moore as well, as clients raise the bar on what is expected from that client experience, so how they interact, what type of information they're getting, how that's presented, we need to respond to that. And so I guess how are we delivering on our promise of providing client service, or excellent client service in this case? And the reality is that our clients have a lot of different definitions of that. And I think demographics are playing a huge role in determining those definitions. So some of the things that we've been doing in response to those changes, I think the most recent example and a really good one is our online portal for our clients. So essentially what we're trying to do is we're working towards breaking down that barrier between the data that our clients want and need to see on a regular basis And I guess, we probably still have a ways to go, but moving away from pushing information to our clients and allowing them the ability to pull information when they want it and how they want it. So rather than waiting for an email notification or navigating to our website, for example, when they log into their portal, they're able to get all of the pertinent information that they want regarding their investments. But then there's also quick links and navigation that they can jump around to all of the other information pieces that we have on there to round out their understanding of what's going on in their portfolio and what our thoughts are on those items.
On the technology front, I guess I'd make a couple of observations just from an investment manager point of view. Obviously, this is a more podcast, so we're going to give mostly more kind of examples. But we recently hired a data scientist. So if you overlay investment management and data scientists like 10 years ago, well, maybe that was coming a little bit. You saw some PhDs being hired onto trading desks and whatnot. But combining computing power with a data scientist seems to be accelerating our ability to find new opportunities. So the real data point I fixate on is our data scientist came in, and within a month, I think he was able to more efficiently move the data so that we could run 500 discounted cash flow models in 2 hours when it used to take 18 hours.
Yeah, it just absolutely blows my mind.
Right? So that's one function of the technology, I guess. And then from a client point of view, I think the trends are pointing to, and it may be more as committees roll over at not-for-profits and kind of this millennial influence comes in, I think millennials are highly engaged in their environment, including getting more involved in not-for-profits.
Absolutely.
So with that comes a demand for different client service models, maybe deeper questioning. How do we, as an organization, not-for-profit organization, demonstrate results?
I think it's absolutely driven mainly by younger individuals that are joining and working either directly at the foundation or they're working as volunteers on the investment committee. And they're having all of these incredible experiences out there from a customer experience standpoint. Think about dealing with an Amazon or how easy it is to Google around things. And, they're expecting that and they're accustomed to that experience. And I think it's only natural to expect it from your investment manager as well. So I think those are areas that investment management firms, I know we are focusing on putting a lot of resources behind and thinking more deeply about as we move forward.
I think we're ready to transition.
Before we go to that, I think it's important to highlight the fact that, a lot of the times when we talk about technology entering some industry and disrupting, as it were, we're talking usually about, the robot overlords taking over and doing everything, right? When often what is unfolding out there is that we've got this human plus machine combination going on. So I think that's more of what we've embraced and what we've seen have more positive outcomes. So your example about running those DCF models is incredible because think about the time that opens up. Think about the screening that helps us with. And it allows us to allocate our resources in a much more effective way, which ultimately should, and we would expect, to end with better outcomes for our clients.
The CFC certainly would have a focus on helping foundations in Canada adapt to technology or give them access to technology, perhaps how to more efficiently generate donations.
Right.
So there's plenty of, I think, shared models out there that, whether it's Giveology or something else, it generates tax receipt for the donor, like it's seamless, and you can direct your donation now online. It's a fantastic innovation that's being applied globally.
Yeah, I think it's all about reducing friction between two parties, essentially.
Another question, Andrew, is maybe more specific to how foundations, how not-for-profits are trying to establish ways to invest in the community. So there's lots of labels out there. I think the most well-known label is impact investing. So you have a not-for-profit that wants to target a specific program, and they will generate donations maybe specifically for that. So let's talk a little bit about impact investing. The question was, does more do this type of thing? And quick answer is No, we don't, but we can offer some perspective on that. Let's just have a discussion.
Absolutely,
around
yeah. I think you touched on it really briefly there, but I mean, for those who don't know, I guess impact investing would be, in a very simple way, I guess, investments that are made with the intention to generate some sort of measurable impact alongside a financial return. So normally that's within the social realm or the environmental realm. The example that I would give, and I'll keep it local here to Calgary, is the Calgary Foundation. So they have a formal impact investing approach that is all centered around kind of providing financing, so debt, to other charitable organizations within the Calgary community and surrounding area. So they would do things like bridge financing, so that would be short-term credit available to other smaller organizations. So if they find themselves in a period of time where they're in between funding cycles, but they've still got all this granting that they've committed to, that's something that could come in really handy for them. And a larger organization like the Calgary Foundation can provide that. Similarly, I think they can provide debt to scale up an enterprise at a faster rate than normally they would have otherwise. And they can also work alongside more traditional financing methods. So combination of bank financing as well as financing from a community foundation can allow an organization to go further and faster than maybe they could have otherwise. So I think that's a really good example of that unfolding from a community foundation standpoint. I would argue that community foundations as general, and I know we've chatted on this just recently, is that they are kind of the true embodiment of impact investing. So if you use that definition that I used at the beginning, which was to have some sort of impact alongside a financial return, well, that's exactly what community foundations are doing with their portfolio and their granting together.
Let's talk a little bit about planned giving and donations. That was one of the subject areas that was submitted. So changing gears a little bit, but what does planned giving mean? How can it set up a not-for-profit for kind of long-term stability?
Yeah, I think in this sense, the question was centered around, what are some more tax-effective ways to give money after you've passed away, for lack of a better way to put that.
Right.
So a lot of people call this gifting from the grave. It's setting yourself up where you can donate money after the fact that you don't need it anymore, essentially. And there's a number of, I guess, different ways to do this. Some of the ways that we've talked about with some of our clients and other stakeholders in the foundation space. There's a lady by the name of Kathy Hawksworth who works with the Edmonton Community Foundation who has given a lot of good information to us on this. So you can essentially do it one of three ways that I'm best aware of, at least. You can write it simply in your will that you want to donate a portion of your estate to a foundation. Simple enough. You can designate a piece of your life insurance policy to go to a foundation or a charitable organization. And lastly, you can do the similar thing with for example, your RSP, your RIF, or your tax-free savings account. You can designate a beneficiary, and that can be a charitable organization within here in Canada. So in general, we call all of these estate gifts, and they come with the ability to receive a tax receipt and have some sort of relief on the donation, on the amount that's going. There are some considerations. The receipt is actually issued, or the value of the receipt is issued to the charitable organization at the time that they receive it. So it's not at the time of the death of the individual. So that's just something to be aware of, that there could be a gap in time going from when a person passes away to when that money actually arrives at the charitable organization.
So that would be probate, period.
That would be a part of it, yeah.
Okay.
So on that note, gifts made from an insurance policy or through a designated beneficiary can tend to move a lot quicker because they're just going from an organization to another organization. Whereas when you write something into a will, not only does it have to go through the entire estate process, it also has a lot of eyes on that estate process. So you could be opening yourself up to someone that you didn't want to have eyes on your estate. So that's there could be some privacy issues there. In an extreme case, a charitable organization could even have some sort of administration over that because they are involved and they are named in the will. So it is more often that we see things written in a will and donated to a charitable organization, but it does move a lot slower.
Last subject area. on the question list is there were several questions around what's the appropriate asset mix? How do I deal with volatility? Markets are so-called skittish or acting up right now. So yes, this is, I mentioned top of mind a few minutes ago. I think this is top of mind. I guess you and I deal with these questions more frequently now. So let's give people a sense of, okay, well, there's volatility out there, but how do we manage through it?
So I think it's always important to speak on this topic with full context. So I think you start with, as somebody working for a foundation or sitting on the investment committee, you want to gain a really good understanding of what the purpose of the portfolio is. So the first part of that is figuring out what we call the spending requirement for a portfolio. So you've got this pool of capital and you've got a mandate to grant into the community. So what is that percentage that you're going to do it? What's the dollar amount that you're going to do that on an average annual basis? So there's where we start. So let's start with that number. You're starting to build what's we call a required rate of return or return objective if it's written into an investment policy. Then you want to layer on top of this, obviously, all of the other administration costs that your organization has, including investment management fees. So that would get you an even higher percentage number. And then I think it's also prudent to include some sort of measure of inflation because that is a true cost to a portfolio over time. It's a time cost of money that's going to take place. So you want to account for that. So then you end with this estimated return. And that would be essentially required to break even in the portfolio. In other words, all else being equal, if you met that target and you didn't have any more money coming in to the portfolio, it should stay the same through time in real terms. So that's where we start.
But to me, it's an important part of it, and it's more on the quantitative side, I guess. But my experience has been, at least recently, that writing an investment policy statement has been part of the get to know you investment manager process, right? It's somebody's kind of knows what their organization looks like. They have multiple pools of capital maybe. And again, there's going to be nuances with every individual organization, but your message of, knowing what your financial need is year in, year out, and squaring that against, well, what's our excess capital? So lots of committees will restrict capital, and that's usually the pool of capital we get to manage. So the challenge, I guess, in that is that if you have a short-term pool of capital and a long-term pool of capital, then you have to be clear in designating those and then approaching, I guess, the long-term bucket with an investment policy statement that matches that time frame.
Yeah, that would naturally be the next step, is to figure out what the time horizon is as well. So again, most foundations do have both a short and a long-term mandate in front of them. They've got to grant money on a year-to-year basis, but they've also have this pool of money that they have to have available to them essentially in perpetuity. So those two things together, so a spending requirement, estimated rate of return, whatever we want to call it, as well as a time horizon, that gets you to an understanding, say for you and I as institutional portfolio managers, to figure out what their ability to take risk is. Then we need to figure out what their willingness to take risk is. And that's where I think you were just alluding to, is getting to know the client. So finding out just how much volatility a committee member or a committee as a whole can stomach on a year-to-year basis. How much can your donor base stomach on a year-to-year basis?
Yeah, that's an important consideration.
Yeah, absolutely. How much sleep are they getting? How much sleep are you getting, knowing that your portfolio is maybe taking wild swings in the market, or maybe it's not? That's what we're trying to get an understanding of, both two sides of the coin, the ability and the willingness to take risk.
Yeah, and sometimes perception is reality. So the perception is, well, yeah, we've got a time horizon that's beyond 10 years, it's 20 years. But the willingness...
It's next week.
Yeah.
Yeah.
So it's, and we run into that all the time, where you add the human factor at the committee level, and there's a real difference in that. And you get through the discussion, you go through it, and eventually you get through the discussion.
Yeah.
And for the most part, I think we get to what we found worked for clients over the long term is a 60-40 type asset mix, where you've got equities, fixed income, you've got a long-term objective, and over time that seems to allow people to manage through the year-to-year volatility.
Yeah, the asset mix becomes a reflection of that willingness and that ability to take risk. So you've got, we've joked about this before, but I've referred to as cash and bonds. So if you've got a traditional balanced portfolio of 60% equities and 40% mix between cash and bonds, those cash and bonds are your goalie and your defense. If you're a hockey team, for example,
yeah.
So we want them to be able to kind of lock down the fort when things get a little hairy in the markets, like we've seen obviously in October and November this year. And then we've got the forwards, so that's the equity part of the portfolio. But we don't just want them to be snipers. We don't want them just be all guys going to the net. We want them to be two-way players. We want them to have a sort of a defensive mindset. So I think the next step within equities is to always make sure that you're broadly diversified across geographies, industries, sectors, whatever. And that's important because those different countries and regions and sectors and different company sizes, they're going to go through different cycles at different times to different degrees. So that's going to smooth things out if we've got a really broadly diversified equity portfolio to also be in conjunction with that cash and bond element.
I love the way you closed it out, but I do want to ask you the challenge question of the podcast. So it's your own fault too, Andrew, because you made the analogy. So if you had to pick 5 players to build your 60-40 portfolio out of, give me the 5 best players in your opinion that would build that 60-40 model.
So I'm a Boston Bruins fan, as you know. So the 5 players, you're actually missing one. There's 6 on the ice at most times.
God, you don't need a goaltender, do you?
Unless you're down by 4 goals and you've pulled the goalie.
The defense is just so good you don't need a goalie.
So sorry. I'm gonna go with Tim Thomas because he won us a Stanley Cup. I'm gonna go with Ray Bourque because I grew up watching him, as well as Paul Coffey on the defensive side of things.
Okay, good skater.
And then I have to go with Cam Neely as my first
good
forward.
One. Yep.
I've always been a big fan of Glenn Wesley. I don't know if that's even going to land with a lot of people.
I don't even remember Glenn Wesley. You probably know his number.
Don't off the top of my head.
Oh, I thought we'd get that one.
And then finally, Glenn Murray, who was actually a Nova Scotia native, so he's been a great goal scorer for the Bruins for a few years.
Okay, I love that because we closed on a personal interest and we built it back into a 60-40 portfolio. So thanks, Andrew. I think we had a good informative conversation for Not-for-Profits, and we'll have you on again soon.
Awesome. Thanks, Cam.
Hey, everyone. Cam here again. To subscribe to the Art of Boring podcast, go to more, that's mawer.com/podcast. If you enjoyed this episode, leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Again, thanks for listening.